Wall Street is launching a new ETF that tracks the S&P 500 without the payout of dividends. So why could this be interesting to some investors? Now, if you look at the performance of the S&P 500 since 1926, between 30% and 40% of its total returns have come from the payout of dividends, which is cash income to holders of shares. Now, to some investors, those dividends are part of the attraction of holding stocks. They want that cash income coming out to them regularly. But to others who may want exposure to the overall growth or capital appreciation of the S&P 500, those dividends can actually create a different issue, which is a tax bill when they get those dividends in their bank accounts. So now some Wall Street firms are trying to create products that have the benefit of the S&P 500 growth trajectory over time without the dividend payouts and therefore the taxable income to shareholders. One example is the S&P 500 no dividend ETF, which is launching this week by Roundhill. How this works is instead of holding S&P 500 actual stocks like Apple or JP Morgan, this particular ETF is going to buy other ETFs and then sell them right before dividends are due to get paid out. As a result, investors in this particular product do not get the income tax bill. Now, this product is launching right as the S&P 500 is actually paying out record levels of dividends, and also at a point in time where the market is starting to think perhaps interest rates are going to come down. And that's exactly when dividend-paying stocks tend to get more popular, and as a result, their share prices have a tendency to go up. So who's going to use this product? Well, some people, like me specifically, want to get their dividends coming in. The reason is you get the benefit of compounding if you reinvest those dividends either into the same stocks or into others, or you just want to have control over your cash and figure out how you want to use it. For others, though, they may want to have exposure to the S&P 500 increases over time without the taxable income, and this works for them. We're going to watch to see how demand for this plays out. It's going to be tricky as tax continues to change, but we'll keep you posted.